Hey, I'm Jason, and this is Supply and Demand Quick Dives, where I take a topic from the realm of economics and I break it down for about 10 to 15 minutes so that hopefully by the end of those 10 to 15 minutes, you will understand that topic in depth and be able to apply that knowledge to any sort of news that you happen to hear about that particular topic. So, what we're going to start with today is there was a big, huge negative reading for the month of May in the Empire State Manufacturing Index, which you may be able to guess has something to do with the condition of manufacturing firms in the state of New York, hence Empire State. So by the end of 15 minutes from now, hopefully, you will understand what the index is, how it is, where it comes from, and you'll understand why it matters, as well as what it has been doing in recent months, how it's been behaving. So in order to explain all that, I need to get myself out of the way so that I can share some charts. So I mentioned this in my supply and demand daily video today, but in case you didn't see that, here's what's going on recently. Like I said, or I may not have mentioned it already, the index fell in May to a level of negative 11.6, and that's all the way down from 24.6. That's positive 24.6 in April, which is a 25-point decrease, and I believe one of the biggest ever seen in the history of the index. This chart here does show the full history of the index. It began in 2001. So I throw these two numbers at you, and what does 11.6 and 24.6 mean? I'm glad you asked, so that's what we're going to go over next. So to put the number 11.6 in a sentence, the way that you would do that is, let's say, okay, so it's May of 2022, and the New York State Manufacturing Index is negative 11.6. What that means is that when we talk about the general business conditions of manufacturing firms in the state of New York, there is a higher share of manufacturing firms reporting worsening business conditions than there are reporting improving business conditions. And the difference between those two shares is 11.6%. That's pretty much it. So the way that the manufacturing index works is the New York Federal Reserve Bank, which is the institution that collects all this data. Every month they send out a survey which provides pretty good coverage. I think they cover about 99.9% of manufacturing firms within New York, so manufacturing heavy businesses. And they ask them a series of questions. The headline figure that I quoted a minute ago, the 24.6 and the negative 11.6, that comes from the general business conditions question, which is the headline question at the top of the survey. And it is exactly what I just explained. There's a question on the survey that says, are the conditions of your businesses improving, or are they staying the same, or are they getting worse? And so what happens is they take the percentage of the firms that are answering in the positive, as in their business conditions are improving, and they subtract the percentage of companies that are answering in the negative, that their conditions are worsening, and then that number ends up being the index. And what that means is that any level below zero indicates that a higher share of companies are reporting worsening conditions, no matter what the indicator is, whether we're going to look at a couple of the others here in a minute. A higher share of the firms, manufacturing firms in New York, are reporting worsening conditions than are reporting improving conditions. And to flip that around, if the index is above zero, then that means that a higher share of companies are reporting improvement rather than disimprovement or worsening conditions. So that's how the index works, and you can use that as a barometer to, get an idea of what's going on here. Before we get into a little bit of detail on the May readings, I wanted to just point out some events in the time series that we looked at just a second ago. So we have these various troughs where the index did go down and even below 11.6%. And I'm just going to quickly run through those events to show you what they are, because that's important for understanding where we're at now. So the most recent of those, you may recognize this giant V shape in 2020. That was the COVID panic, when the New York state government basically shut down many aspects of economic life within that state. So there weren't a lot of manufacturing workers going to work, and there wasn't a lot of demand for the products that come off of their lines. And a lot of these companies were even deemed what's that word? non-essential. And so, panning back a little bit to the year 2015, there was actually a localized manufacturing recession. Now, in economics, when we talk about recession, essentially what we mean is less stuff being produced than some period before, whether it's the year, the quarter, the month, whatever. And so there was a period between 2015 and 2016 when manufacturing and energy and utilities industries basically had a localized recession where there was no hiring and even a lot of job losses in those sectors. And most of the rest of the economy didn't feel it because, again, it was a localized event just to those sectors. And then there are some journalists who even sort of postulate that may have had to do a lot with why President Trump was elected, because, this definitely impacted the remaining manufacturing businesses in the Rust Belt and gave credence to the, idea of jobs being shipped overseas, because it happened to happen during a time when there were a lot of job losses in those sectors. Panning back a little bit more, you might recognize the 2007 financial crisis. I say 2007 because, without going into too much detail, that is when the first domino of the financial crisis actually occurred, was in August of 2007. There's a pretty big drop-off in New York manufacturing at that time as well, and it lasted all the way through 2009, through the depths of the Great Recession. And then the level before that would be the recession that resulted in the bursting of the dot-com tech stock bubble in 2000 and 2001. And so these are the sorts of events that have happened where the index is touched down and below negative 11.6%. What does that say about what's going on right now? Well, there's a great deal of the world is actually in a recession right now, or appears to be in one, including manufacturing in China, manufacturing in Germany. And so essentially the signal that this is sending is that, the same is probably happening or about to happen to the United States. So I wanted to point out a couple of things in the May survey specifically. These are other questions that are asked on the survey, not just general business conditions. Now we're talking about specific aspects of manufacturing firms and their operations. And one of the key things there is delivery times. So to ask that same question as we were asking before, on this question, the way that it would be asked is, have your delivery times gone up or have they gone down? So the share of manufacturing firms saying their delivery times have gone up is 28.9% in May, and the share saying that their delivery times have gone down is only 8.8% in May. I point this out because that is a difference by a factor of 3. So there are more firms by a factor of 3. So 3 times the number of firms saying their delivery times have gone down are saying that their delivery times have gone up. Why is that significant? Well, because first of all, it indicates the increase, or it reflects the increase in transportation costs that we've seen, and it's certainly going to kind of egg on inflation, the rise in the cost of living and the cost of goods and services that we've been seeing, because as delivery times increase, well, that essentially amounts to a lack of supply, and if you have supply that cannot adjust to the demand, then you're going to end up with rising prices. And but the interesting thing about this is that it's kind of skewing the data a little bit, because increasing delivery times are actually an improvement in business conditions as far as this index is formulated. So notice that number is actually a positive 28.9. So there's more firms reporting higher delivery times. And that usually makes sense, because if the delivery times are going up, then that indicates a rise in demand. But in this case, we're seeing record-breaking delivery times, which is really just indicating a short supply of inputs and really maybe really high demand for the products on the other side. But then we have firms that are also on this survey indicating that the value of their orders and the value of their shipments has gone down. So this delivery time is appearing in this index as a positive, but it's actually in this case not really a good thing. It's just indicating that the supply of inputs, the things that the businesses have to bring in order to make the things that they sell. So for example, if it's a t-shirt company, then they have to have yards of cloth, and they have to have all kinds kinds of threads, and they have to have equipment to fix and replace their machines if necessary, stuff like that. And so what we're seeing is just a reflection that all of those inputs to the production process are getting more scarce, which is not necessarily a positive thing at all. And then in the same similar vein, we have prices paid. So this is the cost of inputs for these manufacturing firms. And again, we're talking about, I have a t-shirt company, and in order to make the t-shirts, I have to have some cloth, I have to have some thread, and I have to have plenty of spare parts for all of the machines that are involved in that process. And I have to have some packaging supplies to be able to actually pack up and ship everything. And so what this is showing is even more alarming. Truly, the April number was crazy. So you had 0% of manufacturing firms in New York reporting that their prices paid, their input costs had gone down, and then 86.4%, so like the vast majority, reporting that they were going up. And then in May, you only had a barely slight improvement in those figures. So we have 2.6% of manufacturing firms saying that their prices paid have gone down, so that they've improved. And then you have 76.3, so still the vast majority, over 3/4, saying that their input costs are still going up. What does that mean? Well, there's a little bit of a delay when it comes to producing a good, shipping it off, and getting it on the shelf for a consumer to eventually buy. So what this is indicating is that it's probably going to be, I don't know, maybe 2, 3, 4 more months before the end user, the consumer, at least that much time before they start to see a reprieve from the rising in prices that they've been seeing ever since about April and May of 2021, which is definitely not a good signal either. And then the last thing that I want to point out, how does this relate to other indicators in the condition of the economy itself? Well, manufacturing is not, I'm not going to lie, manufacturing is a relatively tiny part of New York's economy. It's only about 5%. So how much is that going to affect the United States economy as a whole? Well, you take the New York economy and 5% of that, and only a small share of the U.S. economy is New York. So, it's even smaller. It might be less than 1%. And, so does that mean that this indicator is completely useless? Well, no. Chances are that what difficulties the manufacturing firms in New York are having, the manufacturing firms in plenty of other states are also experiencing as well, and probably European and South American and Central Asian firms are probably feeling the same pain, as well as the Chinese firms, which the national government of China has actually clamped down on all kinds of things for them, how much electricity they can use and how much coal they can burn and how much natural gas they can burn and all that kind of stuff, in addition to completely locking people down in a lot of their major exporting and manufacturing cities. So there's a lot of difficulties going on across the world, and so you can use the New York Manufacturing Index not just as a barometer for what's happening in New York, because none of these things are isolated, and factories in both New York and Texas and maybe Wisconsin have to pull inputs from all over the world. And so we're all sharing these sorts of difficulties together, so it's certainly useful. But it's also well correlated with the Industrial Production Index. This is the index that's quantity-based, so not impacted by prices, but it approximates how much stuff in the heavy industrial sectors of the economy, utilities, mining, energy, and a couple of others, are being produced in any given month. And so since there's a little bit of a delay with industrial production, like we got the April numbers, it's May 17th, we got the April numbers today, and we won't see what happened in May until mid-June, until the third week of June. So we can use the New York Manufacturing Index to get an idea of what might happen to industrial production down the road, because we have basically a month in advance. This is a figure that is calculated for May and reported in May, or, for this month. And so we can get an idea of what the condition of industrial production might be a month down the road. They have a correlation coefficient a correlation percentage that's not exactly a correct way of stating it in terms of statistics, but effectively it works. So a 60% chance that the two are going to move in the same direction, essentially there. That means that 6 out of 10 times, if the New York Manufacturing Index is going up, then the Industrial Production Index will also go up, and the same thing occurs if one of them goes down. So we can kind of get an advanced idea of that, and we may start to see a drop in industrial production in June, in the third week of June, when the May numbers are reported. And we can see that by, just studying the New York Empire State Manufacturing Index. So I'm closing in on 15 minutes here, and I do hope that you feel like you've learned something today. This has been actually the first edition of, or the first episode of Quick Dives, and I'm definitely planning to do many more. So I'll be back tomorrow with the May 18th version of Supply and Demand Daily, going over the indicators that are released tomorrow. I hope you'll join me for that, and I'll see you for the next video. Thank you very much.